Good evening, everyone. Welcome. Thank you very much for joining me. My name is Adam from Trade with Precision, and welcome to the Capital Markets Elite Group Live webinar. Tonight's topic is, should you own the A team in Q1? So the very first thing that I would like to do, please, is just make sure that you can hear me. From what I can see on my dashboard here with GoToWebinar, it's all green lights, which means that the sound is good, connection is good. I would also love for this to be interactive. So if you do have any questions, please feel free to ask. As we go through, I'm just expanding the questions box here. So I do have the questions box here. And hopefully the sound is good and you can hear me loudly and clearly. So I think what we can do here is just proceed. Let's kick off and I want to give you a moment to digest the risk disclaimer. And while you are doing that, I'm going to give you some background behind myself. As I said, my name is Adam. I am a chief market analyst. And I am both a day trader and swing trader. I also manage a stocks portfolio for close friends and family. So my general source of income is usually through trading related activities. Now, I'm based in the city of London, and I'm also largely a technical trader. What else can I tell you? That's really it. I also like to take advantage of very strong trends across all the different asset classes. Okay, so I think that gives you enough of an idea behind behind myself. Let's have a look at this evening's agenda. So we're going to do some trend analysis of Apple and Amazon and Alphabet, and I think a few others. Will have more than enough time to do that, and which stocks could outperform over the next 3 months. We are currently in a bull market. So now it's going to be a lot more about patience and discipline and timing, almost more than anything else, but the direction is pretty much preset to the upside. Pretty much a foregone conclusion. Also on the agenda, strategies to day trade the trio. Should you prefer a shorter term time frame horizon? I think that's a great idea. We need to talk about the daily, the weekly, the monthly. We need to talk about multiple time frame analysis. What are the risks that in terms of how the behaviors will be different on the different timeframes, and how to what to look for when we are stalking those particular instruments. I also want to talk about how to gauge momentum to determine if reversals could be forthcoming. That's a key part. There's a real world example. When we have a look at these, we need to take into account what's going to happen on the weekly charts versus the daily charts, and how we're going to see. Obviously, every time frame has its own extension and retracements. And for example, if a weekly chart is going to start a retracement within an uptrend, then what is it that we need to be looking for on the daily time frame? Finally, we're going to talk about how to create a stop loss strategy using on condition of or one cancels the other orders to protect against larger drawdowns. There we go. So let's go across to the platform. I've just sort of got my little list on the right hand side here. And not too important, we really want as much space as we can get for most of the majors. One of the things that I've been looking at in general is the overall bullishness of the market. And what I want to do is talk about a few of the characteristics. So I think, one of the things I just said was that we are in a bull market, and therefore the direction is pretty much a foregone conclusion to the upside. I want to explain why that is the case. There's a number of different criteria, and I'm going to focus mainly on technical criteria. So this can often be a divide between individuals who are, some people are technical analysts, some people prefer the fundamentals. A lot of people are fans of the fundamentals because it gives them an explanation as to, they feel that they have an understanding as to why the market does certain things. But having said that, a lot of people who study just the fundamentals aren't necessarily outperforming the technicals. And really, in my perspective, I'm going to sort of, from my perspective, in my opinion, I'm going to make my case to you. It's the same information. We are looking at the same information. It's the same information looked at from, so in other words, technical analysis and fundamental analysis are two sides of the same coin. So let me just give you an example of that. Let's just say that I'm looking at a company's monthly profits. So I'm looking at 5 to 10 years worth of a company's average monthly profits in terms of assets and liabilities and profits. And each month it makes a little bit more. And if I asked you then to plot that onto a graph, I might be looking at something similar to what we're looking at here. So based off of that, if none of the conditions out there, environmental conditions change, excuse me, my apologies. The delivery has just arrived, and of course the dogs have kicked off, so I apologize. They'll calm down in a moment. So the thing is that based on several years worth of performance, based off several, excuse me, 1 second. All right, so based off of several years worth of track record and performance, it's not unreasonable to think that in the coming months, the performance will stay the same. So in other words, we're using a technical chart which has plotted out the behavior. We've converted numbers into a visual representation. And actually all we're really doing is extrapolating on that for a sort of more of a medium term, shorter term and medium term outlook. And that's really the simple concept behind technical analysis, is that if we look at the heartbeat, if you think of that as the actual heartbeat of a company, visually we can get a sense of whether a company itself is performing relatively well or if it's not, if something is really struggling. So this is a really sensible way of looking at the markets. Now, I said to you that I would talk about how we determine if something is in a bull market or bear market, and I'm going to keep it relatively simple here. The first thing that we would do is look at the weekly time frame. So we'd look very much at the weekly time frame, and if price itself, I've got three sort of moving averages here. I've got a red 50 simple moving average, a 20 simple moving average, and a 10 simple moving average. So red, blue, white, 50, 20, and 10 simple moving averages. We can use exponential. The differences between them is not that big. We're talking standard deviations of a few percent here and there. Doesn't really completely change the picture. So it's more as a preference for the individual who's looking at the chart. Now, the general rule of thumb, and it is a very general, but it is nevertheless is a really good starting point, is if price action, which is the candlesticks, if we're looking at candles here, if price action is sitting above that red 50 period moving average on the weekly time frame, we are generally in a bull market. So it helps, especially if we're looking at an index, for example, such as the S&P 500. But if we take even a well-known ETF, something that is very similar in terms of correlation, we can see if the performance is very similar and generally correlates or highly correlated to an index, it will be sufficient enough for us to use it. So for example, here, if we go back and we look at, this is looking at growth stocks, we've got QQQ as an ETF. In all these periods here, generally, as soon as we're above that 50 period moving average, we are technically generally in a bull market. Here you can see we had a little bit of a dip below that. We've had a recent bear market here where we dropped below that. We're now back up above it, and so we're in a bull market. Now, let's talk about that a little bit further. If we switch this over to a monthly period, okay, so we want to have a look at this from a monthly perspective. There's a couple of things I want to talk about here, which are very important. So part of the reason I'm in doing this is I want to invest a little bit of time in talking about our mindset and our outlook, and I guess you could call it our sort of our basis for believing, our faith in the resilience of the market. We need to keep in mind that the stock market is meant to perform well, especially in the world's largest economy. The US is by far and away the world's largest economy. At the end of World War II, 1945, the US possessed 95% of the world's wealth. Now, over the last 20 years, especially since 2005, China's economy has had a lot of growth. It looked almost as though it was coming head to head with the US economy. However, now it has shrunk to 60% of the US economy. So the US economy still by and far and away, I was going to say by and large, the strongest, healthiest economy in the world, doing very, very well. And we can see this when we have a look at the markets. Now, just following on and adding to that, a couple of things that I do want to highlight here. I'm just going to get my draw tool out and just pick a nice color, something that stands out. I want you to just kind of have a look here. If we go here, sort of 2007, this period over here is the 2007, 2009 global financial crisis. That was actually the bear market, big market correction back then. Since then, a lot of people are worried about the market. It has grown. The global, the population, the global population has increased by about 35, 40%. So many more companies have come into existence. They've grown in terms of scale. There's entire new industries in terms of social media companies, technology companies as well. And so the markets and the stocks and the market cap have actually grown and increased. However, so that all sounds nice and rosy. However, one of the things I want you to just take note of is the angle at which the markets have been performing have started to increase. So now the market starts to become a little bit more aggressive in terms of that, and it's become even more aggressive and even more aggressive in recent years. And so this is arguably, you could say that this is a parabolic move. Now, the way the parabolic moves in any market, any instrument, whether it's a cryptocurrency or whether it's an individual stock or even a currency itself, is that generally what happens with these parabolic moves is that when they have a correction, if we just draw a line that goes straight through it, generally speaking, when that parabolic bubble bursts, the market tends to come back to the original general angle of momentum. That's what it tends to do more often than not. In fact, off the top of my head, I can't think of a single example that doesn't do that. Doesn't mean they don't exist. It's just I can't think of one right now that does that. They tend to come back to that. So the reason I want to point that out to you is that we've had a beautiful correction. We've had a really strong growth period, and we've had a really decent correction. Why does this matter? Well, we needed one. We've had so much growth over the last 10, 15 years. We needed to have a correction. And so a lot of people are worried that what we had recently isn't the big one, but actually there's a lot of evidence to point out to. If you look at the correction in 2007, 2009, and you look at what we went through in 2022 and parts of 2023, that was a really massive, massive correction. Here's COVID coming out. We've had a beautiful correction. So let me kind of sum up. We have had a massive correction in the markets, one that has been coming due for 10 to 15 years. Really big, and that's post-COVID. It's not even including COVID, separate to COVID. So what does it mean? It means we're not due for another correction, generally speaking, for a very long time now. There is the potential for us in this new bull market, because this was our bear market here. In our new bull market, the potential is there for the current bull market to continue for several years. We've had such a strong correction that we could run. I mean, if you take 2007, 2009 global financial crisis, there wasn't a correction again until COVID. So that's how long the last bull market ran. Okay, if you want to do that. And then from that point on, we had a shorter one. So maybe, yes, what will happen is we'll have a sort of more extreme moves and then we'll have corrections more frequently. So the difference in behavior, going forwards will be 2, 3, 4 bull years and then a bearish year, and then the angle and the aggression of it will be maybe greater and greater and greater, and then at some point in our future, maybe we'll have a much bigger correction. But I want to put to bed the idea that we're due for a correction. We're not. We've had a correction. 2022 and 2023 was our long overdue bear market and market correction, and we've just managed to come out of it. So therefore, it's worth our while to put on, and definitely when we remember that the stock market in general is made up of winning companies. Over the last, if you go back to the fact that the Dow Industrial Average was created in 1896 by Charles Dow, it's made up of companies that own the market, that have that market cap. And as they get weaker, if they fail, they get removed from that index, and newer ones get added to the index, and newer companies have to qualify to be listed on an exchange, and companies that don't perform well get removed from an exchange. So in other words, the entire system is built around capturing, if you think of it like the Olympics, it's meant to be made up of the best performing companies within, in particular regions, countries, or around the world, in sectors as well. So it really is meant to perform well in general. So all of that really creates the basis here for us to be optimistic about the future. But now it gets tricky. Okay, now it gets tricky. So if we go back to that weekly time frame, I want to sort of give us some perspective. As I said, if we are above that red 50 period moving average, we're generally in a bull market. Excuse me. We've come out of a bull market. This was around about March last year, and then we had a big correction, of which a lot of the markets thought that was going to be that we were actually going to go into a second leg down. A lot of people were really wrong about this, including, by the way, an investor / trader that I admire very much, which is Michael Burry. Michael Burry, you'll know him from The Big Short, and he really did call the 2007-2009 global financial crisis, so you'll know him in that. But he was wrong about this, and he was expecting a bigger correction, a second leg down, and he ultimately lost a lot of money, and that's fine. He made some money on the moves down here, and then he thought there would be a second leg down, and there wasn't. And this is a classic, and I mean classic bull flag. Classic bull flag. market broke out, and we're on our way now. So this is already the very first sort of weekly correction that we've had, and now we're back onto our next weekly move to the upside. So that brings me to my next point here, which is that the weekly chart is really going to be the trickiest thing for us to be able to navigate here when we talk about different time frames. The reason I say that is because if we look at any time frame, if we have a look at a period like this where the market is moving up, right, that means on the weekly time frame, so that'll be on the weekly time frame, I beg your pardon, there's your weekly time frame. It means that if you go down to the lower time frame, you'll have daily trends that are doing this. So that means that for traders who are looking at the daily time frames, they will be looking for buying opportunities whenever there is a pullback. So when we have a trend to the upside, such as we do now, there are only two ways, ladies and gentlemen, to get into that market. You can only get in on a pullback when the market retraces or when the market breaks out. Okay, so on a breakout. So you can only get in when the market retraces in this area here or when the market breaks out. So what does that mean? In short, anywhere in this area becomes a viable entry to join a market. Once the market is taken off, you then are in the second half. So in other words, there's a good area and a bad area to get into a market, and the good areas and the bad areas. Basically the bad area is the second half of that move. So here's the second half of the move, second half of the move, second half of the move, and usually what happens is that untrained, uneducated speculators are waiting for evidence that the market is going to do something. They wait and they wait and they wait, and then the market does its move, and then they chase the market. So they come on, they get in too late, and this is really where you hear most of the horror stories, people getting in at the top and in the second half. But basically, from a geometric perspective, they get in on the second half of the move. And we really want to be getting in on any time opposite to that. So on the pullback to the breakouts. This is really where we want to be focusing on getting into the markets. Any kind of a pullback or a breakout becomes a valid entry into a moving market. So to come back to what I was talking about on the daily here, the daily itself, even though the weekly is going up in a straight line, the daily will be having extension, retracement, and any kind of pullbacks will provide opportunities for swing traders. So for the most part, swing traders will be looking, even on the 4-hour timeframes, they will be looking at those kinds of pullbacks. I think the next thing that we need to do is we need to differentiate between trading versus investing. So what I'm going to do here is just bring up a clear white sheet so I can draw this, and let's talk about the difference between trading and investing. This is all relevant, by the way, to what we're going to be talking about on these particular charts. Okay, so trading versus investing, these are not the same activities. So what I'm going to do here is I'm going to pick a nice color, and let's imagine we're looking at a particular stock. Let's just say the S&P index for now. We see price goes up, and we look at a daily time frame. Price goes up again, price comes down, we see price go up, and then we see price go down, and basically over a long enough period we see price go up. Okay, so now let's talk about what is the difference if we're an investor. So as an investor, we are usually dealing with spare cash, capital that we don't necessarily require. So it could be 500 bucks, 5,000, 50,000 bucks, and we want to get a better return on it than we would through a high interest account. That's usually what gets, this is a generalization, but this is how it goes. So we look to put it into either, say, for example, property or some minor type of investment, as well as stocks. Now, historically, stocks and property have been, over the last few hundred years, have been the safest, generally have given a return to most people who've invested in them. So what happens is, as soon as we realize we have the spare cash and we decide we want to, for example, put it into the stock market, then it starts burning a hole in our pocket, and our logic goes as follows. The sooner we can throw it into the market, the sooner it can start working for us. So unlike Warren Buffett, who might say, listen, now's not the right time to get in, I want to wait till the timing is right. It isn't just about finding the right stock, for example, it's about the right time to buy. Usually what happens to us is we don't want to wait 8 months for our money to start doing the work, so we just throw it in. Again, our logic is that the sooner we put it into the markets, the sooner it can start to work for us. So often once that money is in, so again, our entry price is not necessarily important to us. If we like a stock, whether it's Tesla or Nvidia or anything, we want to throw it in and get it. Our logic is to buy as quickly as possible. But once it's in, we may have to wait out the good times when it goes up, the bad times when it goes down. Excuse me, the good times and the bad times. But the logic as well is that over a long enough timeline, if we just leave it it will go up in value. So that's kind of the logic there. The next thing that happens is if we don't really need to take it out and it's increasing in value, often what we do is we either add to it or we just tell ourselves that, well, we'll take it out if we ever need the money, but until then we'll just leave it there to grow. So there isn't necessarily an exit plan. So not necessarily a very specific entry price, not necessarily a specific exit plan. This is a generalization, as I've said. And so that's investing. We just need it to go up in value. So we need something that has a very high probability of going up in value. All right, and so that's how we arrive at where we are in terms of investing. Now, if we change it to trading, let me pick a different color that's also going to stand out here. So I'll pick another color, orange. So trading is a very, very different activity, ladies and gentlemen. Trading is a much more shorter term speculation. We are looking for something, well, actually, let me break it down. Trading is really the difference whereas investing is a much more passive activity, sort of just letting something bake, and we're not necessarily needing the cash. With trading, we do need to earn an income. We need to make money, and ideally, we need to make it as a secondary or primary source of income, and we've got to make that money every single month. Working backwards, so in other words, we have to withdraw the money to pay our bills. We need to make sure that we've closed out those positions, we've banked, we've earned the profits from those by the end of the month so we can take them out. And there's no choice in it. We have to do that in order to pay our bills. So we have to find opportunities that should come to fruition within a few hours to a few days, maybe a few weeks, but they've got to be ready to close out before the end of the month. And we have to continue to find these opportunities on a regular basis. This is very, very different from investing, and most people don't understand that. And their decision-making process and their logic and their rationale is very different, and their actions don't match it, and then they get disappointed. So with trading, for example, we would be looking for a much more shorter-term position. For example, let's say I determine that there is an uptrend at the moment, and I get a very nice little bullish candle. So now we're going to start hinting a little bit at a strategy. I find a nice little bullish candle on my pullback, which could hint that the buyers are looking to return to do another leg up. And so my entry is precisely, let's say, for example, 1 pip or 1 point above the high of that candle, my stop loss 1 point below the low of that candle, and I'm targeting 3 to 1 as an example. So I'm targeting 3 to 1 or a reward to risk of 3 to 1, which is a very common, very reliable, very practical way to engage in the markets. It's very high probability, and I'm looking for that to be the case. The market takes me into the trade, and I might be looking at this on the daily time frame, and over the next 5 to 6 working days, which is maybe a week and a bit, it takes me on and I hit my 3 to 1. Maybe there's a pullback 2 weeks later, there's a second opportunity. I haven't hit my 3 to 1 target yet. Maybe I've hit 2 to 1, so I can take some partial profits. It pulls back, there's another setup. It's a good setup, it meets my strategy criteria. I decide to take another entry, and again, I have another 3 to 1 target on that. So I've got a little bit of profit from the initial trade left over. I've banked some of it, I've taken it out. I've got a new opportunity I add in, and I scale in on another position. But every single trade has a very specific entry, very specific stop loss, and exit point if the market goes against me, and it has a very specific exit point when I hit my profit targets. And this is an area where most people stumble. This is where they start to lose money. They absolutely refuse. They get in on a trade, but they refuse to exit on a trade strategy. They decide to convert their trade into an investment because they believe that something is going to go up. And so in fact, what happens is they lose money because that position, they've overexposed themselves, and that position goes down for 6 months or a year or continues to go down, and they just can't exit that position. So with trading, it's much more shorter term. We're looking for stuff that has a much greater probability of going in our favor than going against us. If it goes against us, we get out at a loss. Ideally, we've capped and controlled that loss. And if it goes in our favor, we take the profits and we close out that position. And we look for new positions. The beauty of trading like this is if we can get in and out of an existing trend multiple times, we can compound our account. So some of the profit we might have to remove to pay our bills, the rest that stays in gets added to our balance, and we compound. So compounding becomes an incredibly important tool for traders. And also they look for different things. They're looking for high probability, immediate moves in the market. So now that I've said that, one of the dangers, this is just one more thing I want to talk about. One of the dangers I've often seen is that a stock, for example, has been going down for 5 years. Been going down for 5 years, and somebody thinks that it's a really good deal because this was a very well-known, for example, we're looking at something like BP. And they go, well, you know what, since, you know, BP peaked in 1999, and since then it has progressively lost value. And someone goes, well, I can buy BP at 50 cents a share, for example. It's not, obviously not 50 cents a share, and that is a really good deal. And the problem is that it just continues to go down for the next 10 years. It's been going down for 23 years. Why would it turn around now? There's no evidence to do it, and so on and so forth. So this is one of the traps that investors go into, thinking that, you know what, it'll turn around this month or this week and I'll make money now, I'll make lots of money. When in actual fact, there are lots of really incredibly powerful stocks that pull back, such as Apple, such as Microsoft, such as NVIDIA, for example, that are offering much more shorter term opportunities with a much greater degree of probability of success and profit. And they are available and they're already going in the right direction. So we don't even have to wait for them to turn around. We really just have to time it correctly. And so that brings us to where we are this evening. So that gives you a really good broad overview of where we are. So one of the things I've done here again is that looking at the chart, the 10 and 20 together provide a really beautiful location. It's a really very helpful, powerful, this is a strategy which helps me identify a location where entry opportunities into a trend exist. So as the moving averages are going up, I like to think of the 10 and the 20 together as a train station, and price will tend to head away from it like a train leaving the station. It'll come back to the station and head away and come back and head away. And therefore, these locations often provide me with really elegant entry locations in to join a trend when it's taking a bit of a breather. So you can see here when it's trending really well, it'll often connect to those moving averages. And for example, this is where we are right now. So right now it's pulled back. We've got a beautiful little bullish candle. This is another thing that often happens. We tend to get a nice bullish candle close to that location. And that usually, in my mind at least, makes me feel that the buyers are returning to this and looking to take it to the next level. And yes, there are going to be periods where, for example, here we did pull back into that area, we did produce a bullish candle here, we then did trigger that and subsequently came back out. So that would have been a losing trade. Now, once you know what you're doing, once you're confident in this, generally speaking, if you get it triggered into a trade and a losing trade, that's usually, and this is what I spoke about in the beginning of the presentation, is where we get the multiple time frame analysis, the difference between what's going on the daily and what's going on the weekly, as well as on the monthly potentially is happening. In this particular case, if we look at the higher time frame, if we look at the monthly, we see a big move happen here and a retracement and an extension, which is likely to go up to here. While we're doing that, we can see the weekly is doing smaller retracements, minor retracements. The weekly goes into a temporary downtrend and then back up into an uptrend because the monthly is doing its retracements. And then if we zoom in further and we look at the daily, we'll likely see that the daily is doing the same sort of thing. It's doing uptrend, downtrend, uptrend, downtrend, uptrend, downtrend. And so we need to understand the context of within which it's like fractals, it's patterns within patterns. We need to know that. Again, here's another area where the moving averages can often be a very helpful indicator. We can get a sense of how far price is from the moving averages, how far the train is away from the train station. It can give us a sense of whether it's overextended. And you can see here, if you look at this overall move here, it didn't really connect back with the moving averages for quite a while. When you look at the previous moves, we had a move here and a move here, and then we had a much longer move. And that resulted in, because we had a much longer move, resulted in a weekly correction. So we do want to get a sense of that. If we go up to the monthly, if I change this and go to the monthly, you can see how we had those periods here, where the monthly had become overextended and away from the moving averages, then pull back to the moving averages and is currently taking off. Okay, we've seen it in the past here as well. A couple of periods here where it sort of connects. Okay, so this is where we are at the moment. So let's go and have a look at our first two contenders, but I wanted to create, I just wanted to discuss the idea here, and let's start off with Apple and have a look at that. So I want to start off here on a monthly basis, and I want to kind of talk about where we are and what's good and what we need to be concerned about, for example. And here you can see very nice, steady. Part of the reason in general, by the way, that we have more growth, more activity in the markets now versus early 20s, mid 2015, for example, is that there are just more people engaging in the stock market. There's more education on it. It's on Instagram. Everywhere you go, somebody is talking about cryptos or talking about Forex or talking about algos or offering services. It's a growing market, and there's way more there's just way more signs and advertising to get people engaging in it, and more people are. It's not a bad thing, it's a good thing. But yes, we do need to make sure that we are educated in this. Do I think that the mother of all crashes could be coming? Which, by the way, if you go back 10 years, there's content talking about that. If you go back 10 years before that, there was content talking about that. If you go back 50 years, there'll be content somewhere talking about how the mother of all crashes is always coming along. We've had a massive correction. It's usually when something catches the market by surprise, such as COVID. COVID caught the market by surprise, and then there was an adverse reaction. But even then, the markets recovered relatively quickly from that. So just to recap, we've had a really nice boom section over here. We had a beautiful, I'm going to call it a bull flag. We had a retracement over here. We've broken out of that. We've already just recently had a pullback, and price is actually sitting here, just off the old highs here. And so the purpose, or what I'm about to say next, is when I look at Apple, Apple itself is not overextended. So what do I mean when I say that? I mean that Apple is not overvalued. Overvalued would mean that it's had a long run and it needs to take a breather. It's had a really big correction. It's just coming back to the old highs from 2022, 2021, and we're sitting near that. So beautifully, what that means is that it's ripe, no pun intended, because it's an apple, but that we are not overreaching. The train is not that far from the station, and that's from a monthly perspective. I would like to see, I can see here that we've got a level of resistance. And so the other way I want you to also think about support and resistance levels, ladies and gentlemen, is to think of them before charts existed, before we had charts. You go back 100 years ago. Before we had charts, there were prices. You would buy coffee or gold or orange juice or pork bellies or a particular stock at a particular price. And it often was round numbers, $10 a share or $2 a share or $2.50 a share. And often psychologically, you would see a number on the board. They would usually only update, if you go back 100 years ago, they would only update the price once or twice a day. And we found or discovered that there were often prices that were significant, psychological prices, 100, 110, 105, or whatever. And that's still the case today. So I want you to imagine that support resistance levels are really just visual confirmations, again, visual confirmations of fundamental prices, or prices that buyers and sellers of the market, buyers and sellers of the market have acknowledged, and it shows up on a chart. That's the beauty. A chart is just really a visual snapshot of all the fundamental data that if you had to put it into a picture, you could see it. There's a quote, and I really wish I could find it. It's in an audiobook. It's in one of my audiobooks, and it talks about how, according to Warren Buffett, there are two things that move a stock price. The first is the actual profits and losses of the company. When it reports its reports, assets, liabilities, profits, losses, how it's doing, and if it's really successful. It's very difficult for its stock price to go down, except if it's influenced by the second thing that can impact a stock price, which is the public's perception of the value of that brand. So a case in point would be Tesla. We're going to have a look at Tesla, and I want you to acknowledge that everybody knows Tesla today. Today, everybody's heard of Tesla. It's not a surprise. Everybody's heard of it. But believe it or not, going back to January 2020, nobody had bought into Tesla. That's not that long ago. 3 years ago. Feels like everywhere you go now, it's Elon Musk and Tesla. But 3 years ago, nobody had bought into Tesla, and he was not as wealthy as he is today. He wasn't even in the top 5 or top 10 billionaires at that time. It was during 2020 that he rose to prominence, and Tesla, the brand, rose to prominence. That's literally how young and how recent it is. Okay, so it's important to understand that prior to that, we'd all heard about Tesla 10 years ago. Everyone was like, yeah, they got the cars and he's doing all kinds of cool stuff, but nobody was buying the shares. And so that is a great example of the public's perception of the value of the brand. Although people were talking about it and everyone was aware it existed, nobody actually started buying the stock. Nobody actually started buying the stock. Excuse me one sentence. Do you want to go outside? You want to go outside? Oh, there we go. My dog is being very good and going outside for her bathroom duties, even in this weather. So it's a really important example of how the public went nuts for it. And you can see it just went straight into a bubble. and then it took a little bit of a hit, as did a lot of other tech stocks. Okay, so tonight I'm going to be politically neutral, and I don't even mean that. I'm just, whether you like Elon or whether you have an issue with Tesla. Most people only have an issue with Tesla because of Elon, so it doesn't really matter. I mean, you know, there's lots of stuff going out there. I just really want to talk about the value of the stock, and you can see its behavior. But it's a really great example of where nobody cared about it, then suddenly everybody cared about it. They all knew about it, but nobody cared about it. Then everyone's involved, and it's become, you know, it's become a bit of a sort of a cult following. And so, but that's a great example. And so Warren Buffett always spoke about that. And for him, his favorite thing is buying a company where the books, where the numbers, the assets, liabilities, the profits and losses are phenomenal, but the public's perception of the brand is off. Okay, it's wrong. So this is a great example here where nobody really appreciated the potential of it, and then it took off. Okay, and so that kind of happens. And we need to understand lots of companies. If we go look very quickly, and this is a true story. I mean, these are companies that I own shares in as well. We're going to look at Apple. So this is a real world stuff, and I love this. This is the excitement. Look at the difference. Look at what happened to Apple during 2023 or 2022 when we had that market correction. Okay, so look at what happened. Look at the distance that it fell here and recovered. Now we're going to compare it. Now we're going to go and compare it to Amazon. And look at the difference. Amazon had a massive correction. So Amazon had a much bigger correction and took off. So I bring this up because I want to talk about how the fact that when you think about it, everybody uses Amazon. They haven't lost their value. And in fact, during COVID, they increased their value. So the company itself and the brand itself hasn't really taken hits. It's not, you know, Bezos isn't necessarily as divisive necessarily as a public figure, say Elon Musk is. And yet Amazon had took a much bigger hit. Now, the reason that can happen is very simple. There's an institution somewhere or a couple of institutions that have big holdings, and they have to offload them on their books because they're taking on water, for example. And so they had more Amazon than they did Apple. So they just offloaded Amazon, and so Amazon was offloaded because other people had to kind of do it. And it's almost like when someone sells something that's really valuable. They sell a record, or they sell a car, or they sell something that's really valuable, and you pick it up at a discount. And it's not because nobody sees the value, it's just because people had to sell it for whatever reason. So I just wanted to show you here that Amazon did sell off further than Apple, but that isn't necessarily. The mistake people make is assuming that the market prices companies perfectly all the time, which it just doesn't. It just doesn't. There's no evidence to support that. The market misprices things regularly. Big institutions can make massive mistakes. If we want to have a look at ARK, we can discuss ARK later on, where Cathie Woods bought NVIDIA right at the top and then got out of NVIDIA right at the bottom, and continuously out of sync. And their analysis was bang on. They just panicked and made mistakes, and that happens. And these markets happen, these big corrections happen because the big institutions get scared. It's not just us as individuals. So I'm trying to kind of explain to you that we're all human, we all make these mistakes. Don't assume that the big cheeses have it all figured out. They can make mistakes and they can panic. In fact, if anything, wow, I know this because I work with people in the city, they panic faster. All right, they just get very nervous. So now let's go back and let's have a look at Apple. So what have we determined from this so far? We've determined that that Apple's not that overvalued. I'd really like to see a bit of a green level here. If we put in support resistance level here, this is significant. We're going to just mark this here. So I'm putting it where it is because price couldn't close above the level there. Then we had a second rejection here, and price has come down to where it is now. Now, generally speaking, the market is looking really nice and bullish. The numbers coming out of the US are phenomenal. We've got pocket bubbles. Let's talk about this as well. We've got pocket bubbles. There's properties a little bit overpriced in parts of the US. Cars are a little bit overvalued, so sales are dropping on cars and property prices are struggling. That's not a bad thing. That's a good thing. In a perfect global economy, only the things that are problematic, that are forming their own little bubbles, would burst. They wouldn't impact the whole economy, just those areas would go. And that's the thing. Property prices have become way more expensive than they were 20 years ago. Cars have become ridiculously expensive, much more than they were 20 years ago. And so if those particular areas are going to form bubbles and are going to burst, that is not indicative of a global crisis. And this is where a lot of YouTube content and rabbit hole stuff really gets stuff wrong. Principally, as long as people have good salaries and are not overspending, we are generally on the right track of things. Generally, Ray Dalio has written a phenomenal book on this called The New World Order, Changing World Order. It's really worth a read. He goes through the history of economies of the British Empire, the Dutch East India, the Dutch Empire, as well as the US versus the Roman Empire, and actually teaches you how there are these repeated cycles, and there are certain core things that you can't get right. If those core things are doing okay, you're fine. If you have good education, strong middle class, you're rock solid. Okay. It also points out, while we're on that if you do have the gap widening and the middle class is shrinking, so you've got a larger, poorer, sort of lower income class, not educated, but lower income class, and you've got a 1% type upper bracket, you're in trouble. You need to have a stronger middle class and a smaller, and when I say class, by the way, I'm referring only to income here, not to education per se. But you do need to have, all classes need to be educated. You've got to have good education. So those things are very important. Okay, so let's talk about this now. So overall, even though we've had a little bit of a rejection here, which would be called the double top, this is the area to watch. One of the things that I'm expecting to happen here is a breakout. I'm actually looking for price to build up towards a breakout here. So if we get a green candle here, we'll see price then next month. We'll see it push up, and eventually we should get a nice little breakout candle there. So that's something I'm looking for there. The alternate to that, I'd be surprised, it can happen, but I think it's unlikely, is that price breaks below this low. Let me just clean this up. Price breaks below this low. So the market goes from here, closes below the low, maybe comes and connects with a 50 period and then takes off. But in either way, my expectation is that this year in general, this is, we need to talk about this as well. There is a massive, and this is going to impact, it's going to impact Apple, it's going to impact Amazon, it's going to impact all of them. The US election is in November. There is a lot of political divide and political instability in the US, the most since the Civil War, so the most in 260 odd years. And we can't ignore that. That's going to impact the markets, because when everyone outside the US is looking at the US, you're waiting to see what's going to happen with it. So that aside, if there wasn't so much divide that they've had in 200 odd years, then I would be expecting an easy bull market. I'd be expecting something like we had post that we've had in the last 10, 15 years. But because of that, I think there's going to be a little bit more uncertainty. I lean to the upside, however, so I'm looking for more bullish signs. So more bullish signs would be more green candles, potentially a breakout of this level, and any kind of pullback for me to the moving averages would be a potential entry opportunity. So the reason I spoke about the different time frames on the daily and the weekly is it depends. The thing that can happen to most traders is that the weekly becomes overextended and the weekly needs to have a correction, and they end up getting in on the daily here, and the market takes off and then falls down, and they get very frustrated. What's great about this is we're very close to a potential weekly move up, which means the daily and the weekly are looking very good to move away and to the upside. And again, those green candles become really, really good clues. You've got a nice green candle here. For the most part, we should be continuing to the upside. We should be. And so I just want to keep in mind that that is something I'd be looking for. As an investor, so now I'm going to tell you, and this is purely, please take this as not as financial advice, but just giving you information about how I manage my stock portfolio for family and friends, is I like, if you're buying and holding, I love the weekly. For me, the weekly becomes the opportunity to get in, because the daily can wobble around for a bit, but generally speaking, once that weekly comes in, I see these as very good buying opportunities, and they don't happen very often. It's much lower maintenance. So if I got in here, I'd be triggered in on this high, so I'd have to wait 1, 2, 3, 4, 5, 6, 7, maybe 8 months before I'd add to that position, and then I'd have to wait 1, 2, 3, 4, 5, 6 months to add to that position again, to scale in and get more and more and more. It's definitely something, because even if I get it on the daily over here, it's not really going to go anywhere until it kind of gets back over here. So the weekly for me is it's a perfect time frame for buy and hold strategies. And whereas for trading opportunities, it's different, because remember, buy and hold, I don't want price to really have to come back to where I am for a very long time. So therefore, I want to wait for the weekly, and then it heads off. But when we look at it from a daily time frame, we can kind of get a sense of those opportunities. So we are currently in a downtrend on the daily, but from that weekly, I'm looking for price to turn around and head into a bit of an uptrend. So the way I'm going to be taking this approach, remember this key level here is very important. I can either wait for price to get through that level and pull back, and then take my very first pullback. Again, it's always on a pullback or a breakout. Both of those are valid. Here's some beautiful little entries here. Got a bit of a correction here. So again, I've got two choices. I can wait for it to break out on the daily, wait for a pullback, and then look to join into it. Or on the weekly, for example, potentially, again, and this is more of a buy and hold approach, wait for a nice bullish weekly candle, place my entry order above the high, my stop loss below the low, or just if I'm buying and holding. And hopefully it'll be after this move, it'll break out after that. I just want to comment that I am aware that it's below this level, and therefore until it breaks out, it hasn't broken out. Okay, so that being said, let's go and have a look at Amazon. Amazon's great because it's got more room to catch up. So in other words, it's lagging. There's a little bit of a lag behind it. Lagging is a good thing. In other words, there was an excessive sell-off on it, but it's still fundamentally a good company, and therefore it's got more room to the upside. Its next major level of resistance is sitting all the way up here. So it's still got some good room to move. It's had a beautiful weekly retracement, and there's a bullish candle. So if I got in today, I'd be getting in on technically on both the pullback and the breakout, because this candle is the pullback, and it's the very first sort of bullish candle that's arrived, and it's also breaking the high there. So kind of here is a very good place for me to potentially look to get in. I quite like the look of that. It's not overextended. When I go down and have a look at it on a daily basis, you can see that we just had a really big pullback here. The alternative thing that I could do here on the daily basis, especially I would say, if you're just going to do this to me, aren't you, is to wait again for that very first kind of pullback, wait for the 10 and 20 moving averages to go in, and look for that as a potential day trading or swing trading opportunity. I beg your pardon. Here was a potential entry, so you can see the move up and a pullback. It actually came back down after that, but there was another buy entry opportunity in here. So if my stop loss was here, for example, I might have got stopped out, but there was another entry opportunity over there that's taken off. There was another potential entry opportunity here, which would have been triggered in and stopped out. So this is where swing trading, you might want a wider stop loss to allow for the type of volatility. But here was a nice setup that went boom. So that was really nice. We pulled back. In this case, we sort of had a deeper pullback, and here we pull back here. So this one, you can see when you look at it on the daily versus the weekly, it's a lot more choppy if you're going to be a swing trader on the daily chart versus buy and hold. The buy and hold is almost easier. And here's another thing I want to mention here. Most people might think that investors are actively busy every single day. Somewhere there's a documentary. It might be on YouTube, but somewhere there's a documentary of a woman who went through to Berkshire Hathaway to interview Warren Buffett. Goes into his office. She sits with him and she's like, "What's your day like?" And yeah, there are times when he goes and chats with the managers of his companies or does different things. But he said, it's not unusual for him to sit in his office the whole day and read newspapers. He's reading newspapers because he's trying to learn about different companies and stuff, but he does nothing. And he says sometimes they have to wait 6 months for a company they want to buy. So there were large, long periods in both Charlie Munger and Warren Buffett's periods where they did very, very little. Okay, they just read books and they just researched stuff. They didn't take action. So please understand, and I mean months where they didn't have to do anything. So it was a low sort of, what's the word? Low activity type, or no, low frequency activity. I'm not getting the right word. Okay, then someone should be aware of that. But Amazon has some great potential over there. I quite like the look of that. And so yes, if we go back and look at periods here where the trend is really nice and good, there was some, for me now, after 15 years of doing this, some of these setups are very obvious and very easy, but that's because I've been around. I've seen the 2000, I was there, I was born as a trader investor during the 2007-2009 global financial crisis, really during that period. Thankfully not before it, but after it. And it's much better for us. This is now the best time for you, it's better for you if there's a bull period of 7 years, or and in terms of the cycle, it's better for people to get into the markets now, having come out of a bear market, having experienced a bear market, because otherwise what happens is they forget that the markets can crash, and then they think that they are just magic and untouchable. It's all these investors who go through 6-7 years without any kind of really losing money because we're in a bull market, suddenly lose it all when they get to the next bear market. So it's really good to go through it. It's almost like it really teaches you how things don't always go your way. But here you can see some really nice pullbacks. There's some nice entry opportunities there. You could argue there's one, but there's one. There's another one over here in the train station. There's one over there, maybe that one. But even if you didn't get that one, there was this one. There's another entry opportunity there. Another opportunities over here. There's lots of opportunities, and traders will go through that. Then yes, you might have a losing streak over here, but you had winners all the way up there, especially once that trend becomes established. So one of the other things that we had to talk about was losing momentum. So we could use the momentum indicators to help alert us to a potential change in trend. So why would that be? Let's just go back to this. Imagine we have a weekly extension and a weekly retracement and a weekly extension and a weekly retracement. When we look at the daily is sort of moving like this, and then the daily gets here, and then the daily goes into a downtrend, and then it goes back into an uptrend. So the daily is kind of doing this, and then it kind of wobbles a bit, and it goes into a downtrend. So during this period, there are clues. If we are looking at the daily, there are clues that the daily is becoming tired. So the daily starts to show tiredness, and then the daily changes trend. And then when we zoom out and we look at the weekly, we can see that all it is a weekly retracement. So how do we do that? We use the MACD. It's incredibly powerful. It's very reliable. And this is how we use it for professional trading and investing in the city. It's really straightforward. It's a much better way to do it. We do not worry about oversold or overbought. That is not the best way to use it. We use convergence and divergence. So what does convergence and divergence means? Convergence means that if price, the candlesticks are going up, and the indicator, MACD, is trending higher, they are both bullish, which means they are convergent. That's a good thing. That means the trend is healthy. The way that the MACD works is it measures the speed of the market over time. The chart is price over time. The MACD is speed over time. So if the market is slowly losing speed, so it's not going up as much, the indicator will start to drop. If it's been running for a while and it starts slowing down, it's still going up, still creating fresh highs, but it's taking longer to travel a distance than that same distance previously. So in this previous period, it traveled this distance over 10 candles, but then it traveled the same distance over 20 candles, for example. It's taken longer to travel the same number of points to the upside, and therefore it's traveling slower. It's taken longer to do the same distance. So the indicator will start to deviate. So you can see here, as price here is creating these fresh highs, there's a point where the indicator, the MACD, stops creating fresh highs. It's here. So if I draw a line that goes like this, there's a point here where even though we continue to go up in price, the MACD has now started to go down. So what does that mean? Well, in terms of the weekly cycles and the daily, and now the daily is getting a little bit tired, we've started to enter this period of the daily. It means that the weekly is getting ready to do a retracement. The daily starts to run out of steam. Okay, so if I had to draw the weekly might look something like that. And we're starting to do a bit of a correction here. And so we see the MACD starts to drop down. And eventually then, there's a correction. The daily breaks into a downtrend and it matches. So now you've got a downtrend on the daily and a downtrend on the MACD, and they are convergent. So it's really this very weird little patch where just for a short period of time, you have what we call divergence. You've got price going up, but you've got divergence in the indicator. And so for this period here, you've got price going up, indicator going up, price going up, indicator going down, then you've got price going down, indicator going down. So here they're convergent, here they're convergent, doing the same thing, and here they're diverging. And this is unavoidable. You will get this all the time. So it takes practice. You need to learn to spot divergence. And the thing is, it can keep going for a while. You could see potentially 1 or 2 potential trading opportunities before it actually has the correction, but you can see that the weakness is starting to creep in. So that looks really good. And then we had Google. We also got Alphabet. So let's have a quick look at Alphabet before we wrap up. Overall, you can see the bigger picture correction. Let me draw that in. So we've got bigger picture correction, which is here. We started there. And then you can see the bigger picture correction. So those are the bigger moves, the bigger waves. And you can see here, for example, there's your higher lows, but here you've got your lower highs, you've got divergence, then you have your bigger correction. And you can see again, you can switch it up and go to the weekly and see that weekly chart. Here's your weekly chart. So again, you can see it's at a beautiful little flat level breakout. Let's get that. There's your flat level breakouts. Beautiful. Prices couldn't get through there. Pullback, broke through, pullback, reset. Here's a bullish candle testing support. And in the moving averages, you've got your 50, 20, and 10 in the correct order. You've got price above the 50. This all looks good. And so it's finally looking to carry on. But yes, let's be aware it is sitting also near all-time highs here. So it's battling in this area, but generally speaking, it's nice and bullish, not that overextended. Look at it from a monthly perspective. Let's have a look. From a monthly perspective, it's broken up, pulled back, starting to take off. It's not that overextended. The train is not that far from the station. It's just started to take off. So when we got onto the daily, we can see what's going on. And so from a daily perspective, yeah, we've got some resistance that's going to head up ahead over here, just up ahead. And we've had a pullback. Again, I'm looking for those nice little pullbacks. So in summary, kind of what can I say about this? Well, I think the most important thing is when we've looked at the monthlies, we've looked at the weeklies, we can really get a sense with all of these. We know we're generally in a bull market. I kind of think I've made a case for that. We can see that overextended on the monthly or weekly timeframes. They've all started to depart from the train station or the moving averages on the weekly. And now it's really kind of down to the daily. And then it's up to the individual. It's up to you or me to decide. Do I want to get in and out on the daily? And the in and out on the daily is a different approach. It means I've got to have a stop loss in place. I've got to take profit as we go. Or do I want to buy and hold? And the buy and hold the weekly becomes an incredibly powerful, sort of sensible approach to that. So very quickly, let's have another look at a few other charts here. So let's have a look at NVIDIA, just because we've got 1 or 2 minutes left and I want to talk about that. Here you can see NVIDIA had been going through a consolidation. Doesn't really look that obvious here, but when you look at it from a monthly perspective, you can see what's going on. It was very overextended, really overextended, pull back, and it's now started to take off. There was a level of resistance there, and it's managed to break through that. So it's just had that breakout. Looks pretty good. Look at it from a weekly perspective, and you can see here, very, very nice breakout from there. Very good. The thing is, we need to wait at least 2 or 3 months to know if it's a safe breakout, because it takes 2 to 3 candles, and if it comes back within 2 to 3 candles, it's a failed breakout. But it's looking really good. Beautiful consolidation and a breakout to the upside. Tesla. We looked at Tesla. I think we looked at Tesla already. Let's have a look at a few others here. ASML. ASML is something you really want to have a look at. They build the semiconductor, the machines that make the semiconductors that everybody else uses to create their own semiconductors, including, ARM, NVIDIA, all of them, they use ASML products. So here you can see a little bit of a level of resistance, but a beautiful pullback. Nice bullish candle. This is on the weekly. Potential trading opportunity if you want to do it as a trade on the weekly. But there's some level of resistance there, but overall looking very, very nice. Let's look at Disney very quickly. Disney had a massive correction, so it's very obvious from a monthly perspective. Disney, if you think about it, it's come back to 2014 prices, really battling over here, and is attempting to turn around. It's trying very, very hard to turn around. Looking at it from a weekly perspective, that downtrend is starting to slip and try to get above that 50-period moving average. It's trying to get above it. It's trying to change its trend. You can see the MACD starting to trend higher. So this is the inverse. This is when it's trying to go down and the MACD starting to trend bullishly. So we're hoping to see a change in trend here, starting to see this pick up. And the beauty of that is if it does, there could potentially, and this is very much an if or a could, potentially be a nice gap between the lows and the highs. It could potentially produce be a better buying opportunity, because it's fallen so far. It's been really been, it's undervalued. Okay, but again, that definitely for me is, I'm going to say that as a big if. Okay, streaming wars are going on, content, but Disney owns everything. They've got to be making money. So, and then they do make money. The question is, why is their kind of share price so low? Okay, so there's a lot of different things. There's a Meta. I'd really like to encourage you to go and have a look at a few things. Look at Meta. Meta had a massive drop in value, much bigger than Amazon's, and it's recovered. It's on fire. It really is on fire. Beautiful. Look at the quality of that. Very much coming up to all-time highs here. But it's just had a weekly pullback and taken off. Looking fantastic. Looking at that from a daily perspective can often be a little bit gappy, can be a bit tricky, but man, the stability, the smoothness in all of this is really outstanding. So we've spoken about the key ones that we spoke about, that the 18, but just want to draw your attention to the beauty that is out there. There's a whole variety of different things. So I want to say, first of all, thank you very much for your time. I do hope that you found this instructive and useful. This is if you're looking for some really good reading on this kind of thing, quality stuff, I recommend One Up on Wall Street by Peter Lynch. I recommend Value Investing to do, Berkshire Hathaway, Warren Buffett, Charlie Munger. Those are really the sensible, old-fashioned approach that is still bulletproof and reliable today. Keeps you calm, keeps you rational, keeps you thinking big picture, generally keeps you on the right side and not getting into trouble too often. Okay, that's it. I'm going to leave you with that. Thank you very much. I want to wish you a wonderful weekend, and I look forward to seeing you in future webinars. If you have any questions to do with the platform or your account, please don't hesitate to get in touch with the lovely folks. You've got the contact details over here for social media, as well as an email and phone number. And on that note, I'm going to end the webinar. I'm going to kick us all out. I want to say thank you very much and have a great weekend.